Good afternoon, everybody. I believe we are live here. Today is Friday, the 20th of August, 2010, my wife's birthday. So happy birthday, Brenda. But let's go ahead and get started here by taking a look at the S&P 500. We are, for the week, actually, we really didn't make that much ground here. It felt a lot worse, I think. Last week we closed at 108.31, and here we are at 107.53. Now, the volume-weighted average price for the week was up near about 108.50. So on average, the average participant this week who was long did lose money, and of course we did lose some ground. Not a whole lot, but I think the technical damage is worse than what the numbers actually indicate. And I might actually take that back a little bit. I mean, when we look at the 10-minute time frame, we started out trying to get back above that 109 level, and it looked pretty decent. We tested the 109 level. It seemed like it was going to hold, and then we had, of course, that gap lower on Thursday, which we've seen a little bit further selling here today, as we did finish down 35 cents in the SPY. But going back to the daily time frame, we really still remain within this bigger trend, which is or sideways, neutral range, basically, not trend but range, and that's about 104.50 up to that 113 level that we had tried to break out past last week. 109 is the level that's really kind of the midpoint, and will likely be an important level next week again as well. So that's the level that we would likely expect to be resistance moving forward next week. And then if we get up towards there and start backing off, then we'll probably have some good short opportunities. So, anyways, stock, looking at the market and your opinion of the market doesn't mean there aren't some opportunities in the individual stocks. And it all comes down, obviously, always to risk management. I was talking this week about Dendrion, how I think it looks very similar to the way that Green Mountain Coffee Roasters, one of the biggest winners over the last probably decade in this market, if you look at GMCR. But GMCR back here in July looked very similar to the way Dendrion does right now, and it's still kind of not quite pushed up. The bigger level is really the $40 area. If it can get up through that $40 level, then I think Dendrion can continue to move higher. So there's a stock that looks decent. We've also got Hansen looks decent. It's holding on to some gains, and after experiencing a nice weekly breakout here a couple weeks ago. And then we've got earnings related plays like obviously we saw Priceline about 2 weeks ago, and it's been very strong since then. So the big trends higher are really getting rewarded, and I think that you look at Priceline 2 weeks ago. I think that's what you're going to see this car force or the sales force looking like in a couple weeks. Probably moving its way up towards $20 a share. But of course, it always comes down to timing. I was also talking today about Adobe and how Adobe looks just terrible on every time frame, including even this monthly time frame. You look at this thing here, then on a weekly time frame, we have this prior level of support broken. We've got this what's been resistance up here near 30. We've got all these moving averages heading lower, and that 10-week or 50-day moving average is where we've been finding some resistance, with the 10 below the 20 below the 50, and they're all declining. And this morning it looked like it was going to break down, and obviously it didn't. But I think that's one you want to keep on your radar for next week, in particular if it breaks down below maybe $27.10 a share. But the big news this week really was merger related, and a lot of people and I have a lot of respect for the work that Derek Hernquist did, and I retweeted his post this morning. But he was saying, is there a merger put under this market? Because we're seeing companies like Potash, and then of course we had McAfee get taken over as well by Intel, and this is going to keep this type of activity, especially when you have a stock where it's in a downtrend, and then you just get there was very little, if any, leak of that deal, which is good to see. It's really nice to see that there isn't that dishonesty coming in front of the deals, and that other people are acting upon it before it's public. But this is going to keep a little bit of fear in the shorts, that is, and a lot of people are calling for merger Monday and that sort of thing. We have two deals this week, and basically, since this market was ignited on Tuesday with that potash deal, we're below that, and we had the other deal yesterday. So the mergers, you can't say are really providing any strength for this market, because the two mergers we saw this week, we are actually pretty significantly below where we had opened on Tuesday. So this was Tuesday's open at about the 109 level, but we remain below that. It will be reason to be cautious on an overall basis. And when you look at stocks like Adobe and you're thinking about getting short, it's really going to provide that kind of fear in holding a short position, that if you come in on Monday morning, maybe they're going to get bought out at $42 a share. And that's really one of the worst things you can have happen. That is the worst thing you can have happen if you're short a stock. And so the part of Derek's thesis, which I agree with, is that you want to limit your risk exposure through some kind of hedging or just purchasing options. So that if you have an instance like McAfee where it comes, the stock opens 20 whatever dollars higher. Or $15 higher, then you're not going to, just wake up and really get hit hard in the face by a 2x4 is what it really boils down to for those who were shorted. So let's go back and take a look at these markets. And thanks for the people who had mentioned this, ML237 that I'm on here, Mish from Market Minute, Doug, of course, and Fibline. But anyways, let's take a look back at this S&P 500 and where we are. We're in the midpoint of the range. It feels a lot worse, I think, to the average participant than it really is, and that's because we've had two tough weeks. But we had this big rally before, that started out in early July, and if we look at the Fibonacci, and we can see right now that from the July or June lows to the August highs that we've seen so far, we've retraced 50% of it. So you can't even call it a failed move yet, a failed rally. And when you put it in context of this daily time frame, we're in the middle of that range. It's a range-bound market with opportunities really for shorter-term traders and just individual stock picking. The weekly chart, however, on the SPY really does look pretty ominous, and the only thing that's really going to change that, I think, over the next couple months, the longer-term picture is a move back above 113. If we remain below 113, then I think the longer-term trend really remains highly cautious at best. But we've got all these moving averages that are crossing back and forth up in here, which indicates indecision, and we have the lower highs and lower lows. So you have to really be on guard that news and surprises could get this market back down towards that level here that we test the lows, that is, for this year, which of course I'll just remind you by putting these on there, was a 38.2% retracement of the lows from the March 2009 level. And if we fail down there, then we're probably headed for a test of 94. And if you read economic headlines, obviously we're not seeing a good picture there. But the danger of reacting to economic headlines is that the news often follows trend, and while we're in this really on the weekly time frame, it's more of a downtrend to neutral on the weekly time frame. But the market follows the news, the news often follows the market. That is, the market's known as a discounting mechanism that looks out and tries to price in conditions of where we'll be in 6 months. And what we're seeing here with this sideways activity is, as Bernanke says, the unusual uncertainty, and no one's really making these big bets, especially since it's summertime. And anyways, everyone's expecting that in September, when supposedly everyone's back, the important people are back in the market, that's when we'll get some kind of resolution of this trend. But meanwhile, it's just going to pay to focus on the shorter term trends. Now, generally, as you know, I like to trade in the direction of the 5-day moving average, and it gave us a little bit of a false sense of security here Wednesday afternoon, but again, you have to take it on an individual stock basis, and then when we get the evidence that it breaks down, you have to react quickly. There was nothing wrong with being long in here and holding a piece of it after that test on Wednesday. What was wrong is had you not reacted to not just the gap lower, because it looked like maybe we were going to get a test of the 109 level and hold, but if you still held after the break of it, that's where the mistake would have come in this week. If you're still holding long positions that you'd initiated this week. The Nasdaq, for its part, let's take a look at that weekly time frame first, and you can see we had a close last week of 44.72. So we did finish up 20 cents for the Qs this week. And again, I don't think it felt like an up week for a lot of people, but actually, for me, it was a great week of trade. One of the better weeks of trading I've had in the last probably 4 weeks. It was the best week in the last 4 weeks, in fact. But we do still have these lower highs, and really, the flash crash low that was basically tied. But this market is really neutral to bearish, and I think you want to just keep it more cautious than anything here until we probably get back above 47.5, and that's still 2.5 points or 5% away. But you look at the daily time frame, we've got this same mess in here. When we have all these moving averages crossing back and forth, this simply represents indecision. It means the buyers are not really in control, the sellers are not in control. We have this range-bound market that is just frustrating the longer-term investor, and the weekly time frame, we're seeing the same thing here. This is potentially a larger picture of distribution, similar to what we saw in 2008, before maybe the next leg lower that would bring us down to towards the 50% retracement. So caution remains in high order here for these markets. I think next week the more important level for the Qs to get above and hold above is probably that 45.20 to 45.30 level. That's kind of been really the midpoint, and where we have that 50-day moving average as well. So 45.20 on the Qs. For the SPY, it's going to be 109 still. The Russell 2000 was up 6 pennies today. You can see that this is the market that has been really hit a little bit harder recently, and this week we had the early strength in this week failed underneath that declining 50-day moving average, and where we have the conjunction of the 10 and the 20-day, the 10 and the 50-day moving average. So you look at this, we're still range bound in here, but it looks a lot worse. Probably feels a lot worse to the average Russell 2000 investor, where we have still this pattern of lower highs and lower lows. That hasn't been interrupted. So all these rallies are rallies really within this bigger picture downtrend on the weekly time frame. We're coming back down towards what's been an important level, just about $59 to $60 a share. And on the 30-minute time frame, this was an important level a couple weeks ago, but here are really some of the more important levels. And I think that for next week, if we can get back above and hold above the $62 level, then we're going to be a little bit more neutral in here. We can maybe breathe a little bit easier, but it's still just a really ugly picture with declining moving averages all over the place. And semiconductors were apparently bouncing from the low end of their range. This is kind of looking like the bearish scenario that I think I outlined on Wednesday, or maybe even last week, which is that we get a bounce from this 25.5 level, and because we had seen a large sell-off prior to that, a 3-point sell-off basically, that a bounce up towards the prior support and the declining 10-day moving average would then perhaps create the lower high on this daily time frame, still within this range though, okay? And the range is still 25.5 to 29, but within that range we have this weakening picture, we have this lower high, and if we break that 25.5 level, where does that leave us on the weekly time frame? This thing just seems to be perched on the edge of a cliff. off. Now, the way that markets transition from bull to bear and bear to bull is, we break trend lines, we turn sideways, we correct through time, and if markets cannot recover and break past the high end of this range, then they're going to break down and continue that pattern of lower highs and lower lows, and then we would be looking at the 24 level, which then, if that fails, the bigger prior resistance down near 22 would come into play. So we've still got, of course, the financials, which are just really weak as well. They had a bad week here. If you look at where they closed last week, 1407. Today we closed the week out at 1383. 90, 85 has been kind of the range in here. We're kind of down at the low end, really, of that range. Now, like any trend line, you want to draw it with a crayon, not a pencil, and ruler, but the financials really give us reason for concern. We have the same thing that the semiconductors saw, which is a lower high, declining 10, 20, and 50-day moving average, and the weekly chart really is just a big mess. The bigger level, if we break really the 1330-ish level, then we're probably and you could say this looks like a big Head and Shoulders top, and I always point out and I always make fun of Head and Shoulders because most of them don't work, and you can look at, like I pointed out the other day, are we looking at a Head and Shoulders top in the SPY, or are we on the daily time frame? Once you clear this up, these trend lines up that I've already drawn in, is this an inverted Head and Shoulders pattern? Well, we'll see, but for now we're just range bound, and the larger time frame gives us reason for worry, for big, not necessarily worry, but caution, and really emphasizes the point that risk management truly is job number one, and that's what our jobs as traders is to manage risk. So that's where we are in these major markets, and I think that everyone's got a case of hey, it's a summer Friday. I'm not seeing any questions here on Twitter, so I'm going to leave it at that. Turn this off. Hope that everybody has a great weekend, and we'll be talking again next week. So again, enjoy your weekend, and I'll talk to you on Wednesday.